Goldman Sachs joining the social media party, pumping $450 million into Mark Zuckerberg's Facebook, according to the New York Times. For a look at what the investment means for Facebook and the prospect for an IPO, we're joined by Tangent Capital Partners General Managing Partner Bob Rice. Bob, always good of you to join us. There are so many things that you take away on a headline which really don't tell you the whole story of what's going on here.
Correct.
So what the Times is reporting is you've got $500 million in new money going into Facebook, $450 million coming from Goldman Sachs. Do we know if that is all a Goldman investment or if they're actually just buying on behalf of some of the investors they represent?
Well, it looks like the initial money is going to be coming from Goldman, but the fact is they're putting together an SPV, a special purpose vehicle, into which they're going to raise money from their high net worth individual clients and probably, my guess is, buy down a bunch of that Goldman Sachs risk. So how much Goldman is going to ultimately have at risk in this transaction is extremely unclear.
So if you were a betting man, this would be more for Goldman about cozying the relationship with Facebook for future banking down the road, as opposed to
the IPO business, of course. My guess is they're going to keep less risk than their IPO fee is going to be at the end of the day.
You mentioned an SPV. Everybody knows what an IPO is, but fewer people know what an SPV is. And in a lot of ways, Facebook is changing the game on how you raise investor money. Obviously, they have that luxury. But explain exactly what they're doing with their investors right now, which has enabled them to this point to avoid going public.
Yeah, I will, and it's a very important trend to understand because it's the same thing that you're seeing in secondary markets. Second market is a secondary market. Another one is called Shares Post. They're all raising money for companies like Facebook, like Twitter, and several the other hot social media companies in the same mechanism. The idea is to avoid the 500 shareholder limit, which typically requires registration with the SEC. And so the idea here is you get up to, say, 450 shareholders in the normal way. Then you create a special purpose vehicle, an SPV, and that counts as one shareholder. Then you sell off the interest in that SPV to maybe 500 shareholders, 500 more. But the total number of shareholders in the underlying entity is only increased by one.
The SEC keeps a very close eye on these types of developments. What about how Goldman Sachs, Facebook, everyone involved in this has to try and make sure they're following the rules?
I think it's a really interesting question here because this is such a high-profile deal. It's going to force the SEC's hand, I think, on how they're going to treat these kinds of developments going forward. They've already launched investigations into some of the other companies like Twitter, Facebook as well, but because of the transactions which have occurred on Second Market and Shares Post, which are exactly like this transaction.
This secondary market has enabled insiders at companies like Facebook and in other examples out there in tech land too to cash in without using the IPO market.
Right.
Do you think ultimately Facebook has to do an IPO, and will they do an IPO?
I think the SEC is really going to. I really do think that this is such a high-profile thing that the SEC is going to be pushed to push them into saying, look, you've gone over the 500 limit. You don't have to do an IPO, but you have to start filing your statements with us. And of course, at that point, you might as well be public. So I think the fact of the matter is that this will tend to push the IPO as the next logical step. Not immediately, but say in 2012.
Next few years. Okay, great. Bob, thanks for your perspective on this story.
Thank you.
Bob Rice of Tangent Capital Partners.